Traders, today I want to share why I am bullish on gold over the medium to long term. We are at a critical moment. Gold is more than 23% below its all-time high. The DXY is testing a strong resistance, and gold itself is testing a very relevant support. I'm Ferruccio. I've been a swing trader for about 8 years now. Gold will thrive. First, I'm going to present the 4 main factors that may contribute to the devaluation of the dollar and to higher inflation. Number 1, geopolitical conflicts, especially the war involving the United States and Israel against Iran. We are seeing a prolonged difficulty in reaching a negotiation, a resolution through diplomatic channels. This was reinforced more recently by the interview of the Secretary of State Marco Rubio in the Senate, when he talked about the fragmented situation of the Iranian regime, which makes it harder to reach an agreement with that regime. Besides that, we have the conflict between Russia and Ukraine, which has already been going on for a long time. More recently, Ukraine has been attacking Russian refineries precisely so that Russia cannot take advantage of the rise in oil prices and the removal of sanctions that the United States implemented in an attempt to control the oil price. An increase in the oil price increases freight costs, which then reaches final products as a whole, and in this way creates inflationary pressure. Number 2, increased spending by the American government. This happens not only because of the race for artificial intelligence dominance, from the construction of data centers to research itself, but also because of higher war-related and defense spending, with a 44% increase in the military budget being expected. Whether the war against Iran is right or not is not what we are going to discuss today. Like many people, I also believe that Iran should not have a nuclear weapon. But today we are going to focus on the facts that contribute to higher inflation and to the devaluation of the dollar over the medium to long term. Number 3, labor dynamics. We have seen an explosive increase in the number of jobs in the United States, which is good for the average American citizen, especially in blue-collar sectors such as construction, air conditioning, and so on. In the latest reports, the number has been surprising. Since April, payroll has been coming in with job creation more than double expectations. This is positive for the people, of course, but it creates inflationary pressure because people will also spend more. The 4th and final reason is the American stock market itself. It is very extended. Just as we had an explosive non-farm payrolls job creation report last Friday, we also had this reduction in expectations for interest rate cuts and this increase in expectations for interest rate hikes by the end of the year. That generated more risk aversion among investors. The main semiconductor companies were already stretched with very high valuations, very expensive valuations. Investors were not only pricing in the 1-year forward price-to-earnings ratio, but also the 2-year and 3-year forward price-to-earnings ratios, which is not natural. All of these companies I'm showing here, maybe with the exception of Micron, already had a stretched 1-year expectation, a higher expectation. Even if you look at Micron, it has a current price-to-earnings ratio of 40 times, and its 1-year forward price-to-earnings ratio is 9 times. This means that investors were expecting Micron to make at least 4 times the profit it is currently making within 1 year. That is a very large expectation and inevitably easy to disappoint. It would not be impossible, of course, but it is the kind of situation where a small problem can create a strong response in the market with profit-taking and position closing. On Friday, in response to the explosive payroll result, we had this drop I'm showing on the screen in the SOX ETF, which aggregates the main semiconductor companies in the United States. It fell until it started testing an uptrend line, a support that represents this trend of euphoria and market optimism around companies related to artificial intelligence that began a few months ago. As the market was approaching the close, price action was still respecting the trend. However, during after-hours trading, it broke the trend. Considering that this is an hourly candle, it does not carry that much weight, so it is more appropriate to watch what happens over the next few days very carefully and then see whether daily candles will close above or below this trend line before concluding whether this was only a readjustment after a large period of euphoria or whether the uptrend has really broken and a bubble is starting to burst. In any case, what followed was a strong drop in technology companies. The ones on the screen are semiconductor companies. For example, We have Marvel, which fell 16%, and Micron itself, which had a better one-year forward price-to-earnings ratio than the others, also fell strongly by 13%. Again, we need to wait a few more days before concluding whether this is only a readjustment after a very explosive rise, or whether this is a trend that is broken and a bubble that is starting to burst. And then you could question this and say that in this situation, the central bank would only need to increase interest rates and use its power over monetary policy. In this way, it would make the dollar and so-called risk-free investments more attractive, and the dollar would start appreciating again. But I'm going to explain why this time is different. This time, it is not possible to repeat what happened in 1980 when Paul Volcker raised interest rates up to 20%. This time, government debt is so large that a much smaller increase in interest rates would already cause a snowball effect that would accelerate the devaluation of the dollar even more. Higher interest rates make newly issued bonds pay more to investors, which makes the debt grow faster. This in turn forces the government to issue even more bonds or print more money to roll over and pay debts as they mature. Knowing this and knowing that there is no way to raise interest rates so much, maybe not as much as would be necessary to control all this inflationary pressure from the factors I mentioned, the Fed will first try to sell assets from the central bank's portfolio. That portfolio is mostly composed of bonds that were repurchased in the past, but possibly includes many other assets as well. In this way, the Fed throws these assets into the market, takes dollars out of the market, and by making the dollar more scarce, it strengthens the dollar. Besides that, Kevin Warsh, the new chairman of the Fed, also commented that he wants to change the rules of the game somewhat and change the way inflation is measured so that it becomes easier for them to hit the inflation target. This is how you also begin to understand that bonds that are directly linked to inflation and that promise a return higher than inflation may not be the best way to protect yourself from inflation. So why gold? I will show you the reasons. Number 1. Gold already has the status of a historical store of value. It is already recognized in that way. In fact, before the Nixon shock, the reason countries accepted using the dollar as the currency for their international transactions and global trade was the fact that it was linked to gold. Only after the Nixon shock did the dollar lose this connection with gold. From then on, in the following years, it started to depreciate more and more. The second reason, the United States has this political enemy, which is BRICS. BRICS is the union of countries that try to oppose the dominance of the dollar. Their efforts, among other things, include conducting trade that is not done in dollars. If one day they really want to remove the dollar status as the currency of world trade, they will need to link the currency they create to gold. Because in the current situation of these BRICS countries, they cannot inspire enough confidence for people to hold large amounts of their current currencies in order to conduct commercial transactions. When we think about these BRICS countries, some problems come to mind. Brazil, corruption. Russia, it has been at war for a long time, to the point where it is hurting its economy. China, social control. India and South Africa, unfortunately, also do not generate enough confidence for investors. I have great respect for all of these countries and their people. However, it is undeniable that the United States is still seen as a place with greater legal security for business and trade. The third reason, President Trump has never hidden the fact that he wants lower interest rates and pressures the Fed chairman to cut rates. If interest rates were reduced to the point where they could pay portions of the debt without letting them increase, that would show the strength of the dollar. However, because of all the other inflationary pressure factors, inflation would explode anyway. And the fourth reason is that if everything goes wrong for the United States and the debt starts to get out of control, then the last resort, in order not to lose dollar hegemony and not to lose this superpower of printing money and diluting not only the American citizen, but the whole world that holds dollars and American bonds, would be to link the dollar back to gold. Linking a meaningful part of the dollar to gold, it would not need to be the entire dollar, and it could not be the entire dollar, would already bring reassurance to investors that they would no longer be diluted at will by the American government whenever it wanted to print money. The price of gold will rise a lot. it will explode upward. It is important to mention that, yes, gold also falls during crises. When you have a crisis, many people sell their entire portfolios out of desperation and panic. This causes the correlation between risk assets to increase, and everything that is not cash or a cash equivalent starts to fall. But even though gold also falls during crises, it recovers better. It tends to perform better than the S&P 500. Let me show you. This is a long time frame chart of gold, a 3-month time frame. It starts in 1970. The gray areas represent periods when there were recessions or crises in the American stock market. If you notice, there were drops in gold during these periods. The strongest one was in 1980, when gold fell 48%. However, in each of these periods, if you compare gold, and now this is the chart of gold divided by SPY, which is the largest ETF of the S&P 500, I am directly comparing the performance of gold versus the S&P 500. You can see that in these periods, gold performed better. It rose in relation to the S&P 500. Besides that, gold also tends to recover faster. The 1980 scenario when gold fell 48.11% is unlikely to repeat again, because this time BRICS is making an effort to remove the hegemony of the dollar. And for that, as I said, they will need to buy gold. They will need to have gold on their balance sheet in order to create an asset that is linked to gold. Otherwise, investors will not have enough confidence to use their currencies on a large scale. Here, I show you the weekly chart of GLD, which is the largest gold ETF. It is very close to testing the weekly support that represents the gold uptrend we have had since 2024. In derivatives, CFDs, and futures, it is already testing this support. Here, on a smaller 1-hour time frame, I am showing that it is fighting right now to hold this support. So over the next few days, we will get the answer as to how gold will react. This is the moment to look very carefully at gold price action. If it recovers the area of $4,400 per ounce and starts printing daily to weekly candles closing above that, then the path of least resistance is upward. If not, if the opposite happens and it does not respect this support, then the path of least resistance is downward. And to the downside, the next strong support will be around the area of $3,400 to $3,500 per troy ounce, and around $370 per share of the GLD ETF. That would represent a 37.7% drop from the all-time high. I want to make it clear that this is not a complete investment strategy, and it is not investment advice. For me, the ideal approach is to build the investment strategies we're going to use with the help of an algorithmic model. Then we can optimize them, looking for better performance, and at the same time, robustness, so that the strategy can survive the market. The market is an adversary that is always adapting, so our strategies need to be built while considering their robustness, so they can resist the market's adaptive responses for a longer period of time. Even if your decisions are not 100% algorithmic, 100% of the time, meaning that you still have discretionary factors in some of your trades, like I do, the algorithmic model forces you to enter your trades from a point of advantage. What I presented to you here is knowledge about fundamentals and macroeconomics, supported by basic technical analysis to explain why gold is at a critical moment right now and why the next few days will be very important. I remain bullish for the mid and long term, but I'll be patient and stay out if gold doesn't show any sign of strength. Until these uncertainties unfold, I hope you stay safe. I'm going to wrap up for now. If you found value in this video, please drop a like and consider subscribing. I will see you in the next one. Ciao.